There are things about running a business that nobody puts into a course, nobody posts online, and nobody teaches you. I had to figure it out on my own. Sometimes the really expensive way, and sometimes the really embarrassing way. So today, I'm being the person that I needed when I started out. We're talking credit cards, good debt versus bad debt, why your network is literally your net worth, investing in mentorships, coaches, consultants, conferences, and a few other things that are going to change how you think completely about business and about money. So let's get into it. If you're new here, hi, I'm Amber, and I run multiple businesses. And on this channel, we are going to show the real, raw, and unfiltered side of being a female business owner in her young 20s. If the last two videos resonated with you, this one is going to hit even harder because we are getting into the practical stuff, the money moves, the people moves, and the mindset moves that actually build something sustainable. Okay. So, first thing, before we get into the business side of credit cards, and we are going to get there is something that you have to do first that nobody talks about, and that is building your personal credit. Here's the thing that most people do not realize. When you apply for a business credit card, especially as a small business or a new business owner, the issuer is pulling your personal credit score, not your business. Your personal. And that's because your business doesn't have a track record yet. You are the track record. So if your personal credit is thin or just non existent, you're either going to get denied or you are going to get a bad rate and a low limit. And neither of those is a win. So let's talk about how to build it the right way. Because it's actually not that complicated, it's just not taught. The first thing that I would tell anyone starting from scratch is to get a starter credit card. Something like the Discover It or the Capital One Platinum. These are designed for people who are just building their credit or rebuilding their credit. But here is the important part. You use a credit card like it is a debit card. You only charge what you can pay off when the bill comes. Because here is a myth that trips people up. Carrying a balance does not help your credit score. Paying on time does. Keeping your balance low, ideally under 10% of your limit. That's the whole game. So your score is actually made up of 5 different things. Payment history is the biggest at 35%, then how much of your available credit you're using at around 30%, then how long your accounts have been open, your credit mix, and new inquiries. The two that you can control immediately are paying on time and keeping that utilization low. And then give it around 6 to 12 months of clean history. Keep around 1 to 2 credit cards. Don't go maxing out your cards or trying to get a bunch of credit cards. Just build a solid, nice foundation to begin with. And that can lead you to better limits, better rewards, and better terms. Personally, I got my first credit card at the age of 18 years old, and there are a couple hacks and tricks that you can use to build better credit faster, like being an authorized user. But I'm not going to get into all of that in this video. So my first credit card was actually a Discover It credit card. And honestly, it was super easy signing up. It's just something that they never teach you how to do, especially in school. And sometimes your parents don't even know either. So once you have that foundation down, now we can talk about business cards, which is when we get into the fun. This is one of the first things that nobody told me, and the first thing that I always tell people when they are first starting off. When getting a business credit card, get it as soon as possible, but not to go into debt. And we're going to talk about that in a second, but for 3 very specific reasons. Reason number 1, it completely separates your personal finances from your business finances, which makes your accounting and tax season much less of a nightmare. And these business credit cards will not show up on your personal credit report, which is the best part. So you are free to use them without it impacting your personal credit score. Number 2, it starts building your business credit score, which matters enormously when you are trying to scale, get a loan, or make bigger investments later on. And number 3, most business cards have better rewards, cashback, travel points, statement credit on the exact categories that you are already spending on. Softwares, advertising, office supplies. You are spending that money anyways. You might as well be building something with it. I got my first business credit card when I was, I think, around the age of 23 years old. So at that point, I had filed as an LLC for about a year and a half or so. And I had personal credit that was being built for over 5 years at that point. I got approved for the Amex Gold card, which isn't always the easiest to get approved for, but it's not always the hardest either. You just have to have a really solid credit score for a while. Plus, I think you also need to be making a certain amount of income every year. But, anyways, this isn't something that I would recommend to someone who isn't the best with money management because the gold card has no limit. So I could be spending on whatever I want, whenever I want, however I want, and that can get you in trouble. So I don't do that. I have financial responsibility that I have built over the years of building my personal credit. So if I were you, I would start with something a little bit more simple and pay it off every single month. Build the habit, build the credit. Honestly, for me, I don't even pay my cards off every single month. I pay them off every couple of days to make sure I am on top of my payments. Now, not all debt is bad, but it is important to know the difference between good versus bad debt and how it is costing you. We grow up hearing all the time that debt is bad, stay away from it, stay away from credit cards. And that mindset, while well intended, that can actually hold you back as a business owner in a really significant way because there is a massive difference between good debt versus bad debt. And understanding the difference is one of the most financial, mature things that you can do. So, bad debt, what is it? It's basically buying things that are going to lose value over time and cost you at the end of the day. Bad debt isn't something that is generating you income. Consumer debt, lifestyle debt, debt that costs you without any money coming back. So, this can look like buying bags you can't afford, jewelry you can't afford, shoes you can't afford, even cars and vacations that you cannot afford. Now, I'm not saying that it's wrong to buy all of those things or that you can't buy these things. I'm just saying make sure that you can afford all of these things. Now, good debt, what is that? Good debt is borrowing to invest into something that is going to generate you an ROI, a return on investment in some way, shape, or form. So it should generate more than it costs. Now, this can look like a business loan to hire a team member that is going to help you scale the business, or to invest into a mentorship or coach that is going to teach you the skills that you need in order to grow and get to where you want to be. A line of credit to fulfill a large contract, investing in software or equipment that is going to increase your revenue. That is good debt. It's a tool, not a trap. So in 2023, I actually bought my first ever brand new car. It was a BMW, one of my dream cars that I wanted very badly. Now, I bought this car knowing that I can afford the entirety of it, not just the monthly payments, but the entire car itself. If I couldn't, I would not have chosen to buy it because I never want to put myself in a financial risk like that, especially on something like a car where there really is no ROI. So, what I chose to do was make a pretty hefty down payment on it, and then I decided I'm going to make monthly payments towards the car because that was actually going to help build my credit. And the banks love to see a user who is consistent, especially on larger payments like a car or a mortgage. So, if you don't have to pay the whole thing up front, I honestly wouldn't because you can leverage that to your advantage at the end of the day. Now, another example, I host a pretty big annual women's conference every year. Tens of thousands of dollars go into putting this conference together with production, flying out speakers, booking hotels, booking venues, catering, decor, AV, all of the above, okay? And what I do is I put all of it on my credit because I know at the end of the day, the conference is going to bring me back the ROI and more, and then I can pay the credit off. So, the best piece of advice that I have here for you is to only go into debt if the debt is going to be worth it. So, the question to ask yourself is will this debt make me more money than it is going to cost me? If the answer is yes, it is definitely worth having a conversation about. If the answer is no, you may want to reconsider. Now, investing in yourself and mentorship is the highest ROI that you will ever get. I want to talk about something that held me back longer than I would like to admit, and that is the fear of spending money on mentorship, on coaches, on education for myself. There's this voice in your head that says, I should be able to figure it out on my own, or let me go on YouTube and watch all the free videos and gain all the knowledge by myself. It's all out there. And that you can't justify spending all this money right now because there's so much free material online. And here is what I have learned. The people who are where you want to be got there faster because of the investments that they made in themselves. And usually that is a mentor showing them the way. A mentor, a coach, a guide collapses the timeline. They hand you essentially the map instead of you having to figure out how to get there in a lost world. The mistakes that they made, you don't have to make them. The expensive failures that they incurred, you don't have to make them. The connections that they have, they can now open up those doors for you. And that is worth real money. And this is exactly why I do what I do. Because mentorship, coaching, networking events, that truly all changed my life for the better. Making those investments on mentorship is what got me to become a best selling author at the age of 20. Making those investments on coaches helped me scale multiple businesses to 6+ figures at such a young age. Making those investments on attending networking events and conferences allowed me to meet individuals who truly changed my life and business for the better. Now, I am not saying go into bad debt by spending $30,000 on a mastermind program on day one. I am saying take mentorship, coaching, networking experiences, and conferences seriously as a business expense. Because the version of you on the other side of good mentorship is significantly more valuable than the version of you who is still saving all this money. Now, a key pointer, I would also not go and apply to all these random credit cards on your own just so you can get approved and go apply for these coaches and mentorship programs and go to all these conferences, events. Please do not do that. I would make sure that you are really well educated beforehand. I personally have one contact, a company that I would go through for all of this, and this is who I send all of my friends, clients, family members, etc. to as well because I trust them wholeheartedly, and I'm going to share them with you actually. I actually have a link for you to get pre-approved to see how much capital you can get access to without actually having to apply for a credit card and ruining your credit and putting yourself in a bad position. So it is best to have someone who can guide you through the right process with the right steps, who essentially knows what they're doing and has the connections to all of the lenders and the banks. Now, your network is your net worth. You've probably already heard this phrase many times before, and it kind of sounds like a motivational poster or something like that, until a single moment of a phone call can lead you to a $5,000 contract or a DM from someone that you met at an event that leads to a collaboration that can change your life. Then you get it on a completely different level. But here's where most people go wrong with networking. They treat it like a transaction. They show up to events thinking about what can I get? They collect all these contacts, all these business cards without building a genuine relationship. They reach out when they feel like they need something. That is not networking. That is using people, and people can feel it. Real networking is about genuine curiosity. It is showing up and being interested in what other people are building, making introductions, sharing opportunities without immediately calculating what is in it for you. The return will always come. It just rarely comes from where you expect it. Some practical things that work: go to industry events and actually talk to people, be curious, ask questions, and see how you can help. Follow up within 24 hours of meeting these individuals. Check in on people when you're not just asking them for something. Be the person who connects other people. This is my superpower, being a super connector. That's literally what I'm known for. And that has helped me in so many ways. Me connecting someone else to another person has never negatively impacted me. That reputation is going to open up way more opportunities and doors for you than a cold pitch will ever do. Now, you want to remember to protect your finances like your business depends on it. Something nobody talks about in the early stages of building your business is your relationship to money, your personal financial health, and your business stability. When your personal finances are a mess and in whack, you have no savings, you have a high debt, no emergency funds or savings, you are going to make fear-based decisions. You will take clients that you shouldn't just because you need the money. You will underprice yourself because you can't afford to lose the sale. You'll avoid investing into your business and yourself because you yourself are too close to the edge personally. Getting your personal financial foundation solid is very important. And honestly, it's not separate from building your business. It's what gives you the freedom to build it very well. Even as a business owner, remember to pay yourself. Keep an emergency fund of at least 3 to 6 months of expenses. And do not blur the line between business money and personal money. The most confident decisions that I've made as a business came from a place of financial stability. And that isn't luck, that's something that you build. So there it is, the business tips that nobody taught us. Not school, probably not even your parents. Every young business owner needs to understand and know. Credit cards, good versus bad debt, mentorship, real connections, your personal finances, your reputation. These aren't just the flashy things. They're not the things that make you go viral, but they are the foundation of a business that is going to last. If you found this helpful, save and like the video, please subscribe, and share it with a friend who is building something because this is the kind of content that we needed earlier on. Subscribe for a new video every single week. Don't forget to drop in the comments what was the biggest wake up call for you. See you next time for some more real, unfiltered, raw content.